All right, let's talk about something wild. Imagine a company, a giant like Amazon, comes out and announces they just had a record-breaking quarter. We're talking $213 billion in revenue. And what happens? Their stock immediately tanks. It makes no sense, right? Well, that's the puzzle we're going to unpack today. What exactly has Wall Street so spooked? So let's just lay out the numbers because they're pretty jarring. On one side, you have this massive, undeniable win. $213.4 billion. That's a 12% beat year over year. I mean, that's a home run. But then you look at the other side and the market's reaction was, well, brutal. An almost 6% drop right after the announcement. How do you even square those two things?
And that's the big question, isn't it? What was hiding in that earnings report? What did the market see that was so bad it completely overshadowed a massive success story like this? Well, it turns out there is a smoking gun. And some people on Wall Street are giving it a nickname. They're calling it the $200 billion AI tax. It all boils down to one single, mind-bogglingly huge number they buried in their forecast for the future. $200 billion. Just let that number sink in. That's how much money Amazon is planning to spend in 2026. This isn't revenue coming in. This is cash flying out the door. And that one number, right there, completely flipped the script on Amazon. So what is the spending? It's something called capital expenditures, or CapEx. It's the money a company spends on big physical stuff. And in Amazon's case, that $200 billion is going almost entirely to one thing: building out the massive infrastructure they need for AI. We're talking data centers, servers, all the hardware. That's the AI tax. And here's why that is so terrifying to investors. This huge spending spree directly hits something they care about deeply: free cash flow. All this spending to build for the future suddenly makes Amazon look less like a sleek tech company and more like an old-school, capital-heavy industrial company. That is a very different kind of investment. And look, this isn't some theoretical future problem. It is happening right now. You can see it on this chart. Their free cash flow is already taking a nosedive. It went from over $18 billion down to just over $11 billion in only 6 months. That AI spending is already taking a huge bite out of their cash. So because of this CapEx shock, the entire investment story around Amazon has been completely rewritten. I mean, the whole conversation has changed. Let's just track how much the focus has shifted in just the last year. It's kind of wild, right? A year ago, everyone was talking about their retail business and if it could get more profitable. Then the conversation shifted to their cloud business, AWS, and whether it could start growing faster again. But now, after this last quarter, forget all that. The only thing anyone wants to talk about is the CapEx shock. Yep, the game has totally changed. The old narrative about making the retail side more efficient is dead. The new narrative, the one everyone is obsessed with, is this high-stakes collision course between their AI spending and their ability to generate actual cash. Okay, so how do we actually measure this? How do we figure out if this massive $200 billion bet on AI is a genius move or if it's just a black hole for cash? Well, there's a key metric for this. It's called the FCF cash conversion ratio. Now, it sounds complicated, but the idea is actually super simple. For every single dollar that AWS brings in as revenue, how much of that becomes actual spendable cash for the whole company? And this slide tells a pretty scary story. Just 1 year ago, the cash machine was humming. For every dollar of AWS revenue, Amazon was pocketing 35 cents in cash. Now look at today. That number has absolutely collapsed. It's less than 9 cents. The efficiency of their cash machine has just fallen off a cliff. So here's the bottom line. They're pouring these billions into AI, but the immediate cash return they're getting on that investment has cratered. It's now costing them over 75% more just to turn their cloud revenue into cash. That's not great. So all of this is setting the stage for their next earnings report. It's really shaping up to be a huge showdown. Wall Street is going to be laser focused on a couple of key numbers that could literally make or break the stock for the rest of the year. And it really boils down to two very clear opposing paths. The bull case, the optimistic view, is that AWS growth stays incredibly strong. We're talking over 22%, which would prove that all this crazy spending is worth it. But the bear case is that AWS growth starts to slow down while the spending stays sky high, which would basically confirm everyone's worst fears. But there's an ultimate red line here, a mathematical breaking point for investors.
And that's the moment when the money going out, the spending, becomes more than the cash coming in from just running the business.
Let's just look at the math. Right now, on a trailing 12-month basis, they're bringing in about $140 billion in operating cash and spending about $128 billion. So they're still in the green. But you can see the danger zone. When that capex number hits their projected $200 billion, if their cash flow doesn't keep up, they will officially be burning through cash. So after all that, all the reports, all the analysis, it really all comes down to this one number. 22%. That is the magic number. It's the bare minimum growth rate AWS needs to hit to make this insane level of spending seem even remotely justifiable. So this is it. This is the number to watch next quarter. If AWS growth comes in below that 22% threshold, the argument that this whole AI push is just a capital-destroying black hole, well, that argument gets a whole lot stronger. Which leaves us with the ultimate $200 billion question. Is Amazon making a brilliant, visionary investment in the future of tech, one that will secure their dominance for another decade? Or are they just digging themselves in an incredibly expensive hole? I guess the next earnings report will give us our first big clue.